The three most important words in investing, according to Warren Buffett, are margin of safety. And the margin of safety is an important concept used by value investors in the past and present. People like Charlie Munger and Warren Buffett come to mind. Benjamin Graham, Monish Prabrai, Spier, Peter Lynch, and Phil Town are among those featuring chevaliers. So, for us aspiring value investors, learning about the concepts of margin of safety is probably a good idea to ensure we're using them in our investing approach. However, we have discovered that the majority of investors have never learned how to calculate an intrinsic value for a company and thus do not understand how to apply a margin of safety principles. We, the Investing Wise Academy, want to share our knowledge on how to do that in this video. Fred here, your host, and we'll get started right away. To begin, we must first understand how to find the intrinsic value of a business, which is so important to Warren Buffett's investing approach and ongoing success as an investor. The intrinsic value of a company is simply its fair market value. It's the current market value of the company. The intrinsic value of any stock, bond, or business today is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset, Warren Buffett says frequently, referring to American economist John Burr Williams' theory of investment value. The present value of all future cash flows of a business added together is the intrinsic value of that business. Assume you are the sole proprietor of the company. Then you'll need two pieces of information to figure out the company's intrinsic value. Number 1. You must know how much money that business will bring you in the future. Number 2. You must know how much those future cash flows are worth to you right now. The amount of money a business makes for its owners is known as the owner's earnings, and the way to figure out how much money a business makes for its owners in a given year is to look at the cash flow statement. Take the operating cash flow, and then subtract the maintenance capital expenditure. The operating cash flow, also known as cash flow from operating activities, is simply the amount of money generated by the company's business operations during that period, while the maintenance capital expenditure, or the amount of money spent simply to maintain and keep the company in its current competitive position, is the most accurate number to use for these calculations. While companies are not required to report their maintenance capital expenditure, some do, and some great companies do, which is very helpful. Most do not, so many investors simply use total capital expenditure instead of maintenance capital expenditure. So that's the cash flow statement's property, plant, and equipment. This does not only include capital expenditures for maintenance but also all capital expenditures for expanding the business. For the sake of simplicity, we'll use free cash flow for these calculations. Using free cash flow is more conservative from a technical standpoint. It is, however, slightly less accurate because it is more conservative. Another benefit of free cash flow is that it is more precise. As I previously stated, you can calculate it from any cash flow statement, making it very easy to locate within the financial statements. It's simply operating cash flow minus property, plant, and equipment purchases. So, how do we determine a business's intrinsic value? For this example, we'll try to purchase Irwin's local store, which only sells snacks and drinks. This is how the free cash flow for this local store business has looked every year for the past 10 years. If you notice, this business free cash flow increases by 10% every year. So now we're going to take the most recent free cash flow number and that growth rate, which has proven to be very consistent at 10%. And we're going to grow that free cash flow by 10% every year for the next 10 years. Then we'll assume that after the 10th year, we'll be able to sell the business 10 times. So, if we put all those numbers into a spreadsheet, this is what we get. And surely, the intrinsic value of the business to us is just adding all of these cash flows together. We simply add them all up, and that is the value of the company to us. As the owners, we will receive the amount of cash flow. If you were to make this purchase right now, the reason it doesn't quite have the intrinsic value is that the cash flows we'll receive in the 7th, 8th, or 9th years of ownership aren't as valuable to us as the cash flows we'll receive next year or the year after that. And the reason they're not as valuable to us is that it will take a long time. Those cash flows will occur in the distant future, and money, of course, has a time value. If you ask me whether I'd prefer $10 now or $10 a year from now, I'll always choose the $10 because I can put the money to work sooner rather than later. With that in mind, we'll discount the business's future cash flows to what they're worth today. We're going to discount it by 15% every year because that's what we're aiming for with our investments. So, if we discount all of these future cash flows by 15% annually, the table looks like this. So now we discount that one-time cash flow that we'll get by selling the business in 10 years for 10 times its free cash flow, and we've got the present value of all the investment's future cash flows. To us today, the intrinsic value of a business is simply the sum of all of these cash flows, so the local store has an intrinsic value of around $306,000. So, if we go meet with the owners and make them a $306,000 offer for their business, we're likely to get 15 returns every year for the next 10 years. Our return will be much lower if the business owners turn around and say, "No, we don't want $500,000 for the business," after 10 years of free cash flow growth. If the business owners are as desperate to move on and get rid of this business as we are, they will say, "Just take it for $200,000. I want it gone." We will make a much higher profit. But overall, for 15 returns each year, $306,000 is the intrinsic value of that business. The thing is, the stock market gives us the value of thousands upon thousands of businesses every day. We can calculate the current market capitalization of each company by looking at its market capitalization. That's a huge advantage for us because it means we can look at these companies' financial statements and calculate their intrinsic value, then compare it to their current market capitalization to see if they're trading at their intrinsic value, at a premium to their intrinsic value, or under their intrinsic value. However, all of the calculations we've done to try to figure out the intrinsic value are just guesses. Yes, we can reduce the risk of our guesses being incorrect by recognizing that there will always be things that could potentially happen to any old business in the future that we can't foresee and control. What if a fire broke out in the local store, forcing the establishment to close for a year while it was repaired? What if a juice bar opened up right next door to our business, reducing our drink sales by 50%? To account for this, we need a margin of safety, so we don't buy our company at its calculated intrinsic value. Because even if we're slightly off in our intrinsic value calculations, it will have a significant impact on our returns. So we need to give ourselves a buffer, a safety buffer, a margin for error, or a margin of safety. A margin of safety is necessary because valuation is an imprecise art, the future is unpredictable, and investors are human and do make mistakes, says Seth Klarman. The function of the margin of safety is in essence that of rendering a necessary and accurate estimate of the future, writes Benjamin Graham. So we take our intrinsic value and subtract a small amount from it to give ourselves a margin of safety. a buffer in case our estimates are incorrect. So if the store's intrinsic value is $306,000, we might only be able to offer the owners $220,000 or $250,000. As a result, we only purchase a business when it is offered to us at a discount to its intrinsic value. But how much below intrinsic value can you go? This is where you have some discretion. For example, experienced investors who are confident in the predictability of future cash flows of a business might choose a 20 or 30% margin of safety. But if you're a new investor or investing in a company that's a little riskier and less predictable, you might choose a 50% margin of safety. Do not misunderstand me. A 50% margin of safety is extremely difficult to come by, and in today's market, you're unlikely to find any businesses with one. However, as investors, we must approach the situation with that mindset. We sit patiently and wait our turn until the businesses we've been studying are presented to us by the market at a price that is significantly lower than their intrinsic value. That does give us that safety margin. If you invest in a business with a 50% margin of safety, you can be completely wrong about the future of the business and still make a 15% annual return. If you can find it, that's an absolute gold mine opportunity. The main reason why all of those well-known investing names I mentioned earlier have proven to be excellent investors decade after decade, they simply do not become agitated by the current market situation. They remain perfectly rational and wait for opportunities to buy great businesses at a time when their share prices are at a margin of safety where there are a lot of upsides and very little downside. I hope that you've learned something from this video. Please comment on intrinsic value. I'm Fred. I'd appreciate it if you left a like on the video. If you'd like more, please subscribe to our channel, Investing Wise Academy. See you in our other informative video. Bye!